Well, this recession is unique in many ways. The depth of the recession, unprecedented. The diffusion, the spread across economies, unprecedented. But importantly also the duration. And investors are really buying into this being an incredibly short recession driven by the COVID outbreak. Data is backing that up to a degree. So this is the German retail sales figure, for example, a huge rebound in sales in Germany. So that's reinforcing this belief of a strong recovery. Secondly, fiscal stimulus. We've already had unprecedented amounts of fiscal stimulus. The markets are expecting more. The US is expected to announce another package over the coming month, perhaps. We have the EU Recovery Fund being debated amongst EU leaders. The markets are expecting something there. And then, of course, here in the UK, there's expectations that the government are going to announce further support measures. Then finally, you have the central banks. Massive balance sheet expansion through the crisis, and the markets are expecting more from the Fed in particular going forward from here. And that combined is giving the markets this belief that you just don't fight the Fed. So investors are willing to take the risk of buying into risk assets in the belief of a V-shaped recovery. And if that proves incorrect, the central banks will be there to support asset prices to the downside. So there's that positive risk-reward balance. And I think that's what really is driving the markets at the moment. Well, I think there's a lot of risks on the horizon. And I'd be surprised if we get through the entire summer months and into September without some degree of correction in risk assets. Firstly, the most obvious is the escalation of COVID in the United States. Interestingly, we've had an interview in the FT from Atlanta Fed President Bostic, who was certainly pretty pessimistic and was indicating that the Fed was beginning to see evidence of the recovery plateauing in the US. And the high frequency data that we look at indicate that also. So for example, Open Table, looking at restaurant bookings. Here you can see in white the bookings in countries or cities that have rebounded quite notably. Those are all European cities. American cities, on the other hand, we're still seeing very, very weak pickup in terms of restaurant bookings. Also Citymapper, which tracks mobility in urban centres and mainly on public transport. Again, in European cities, we're seeing a notable pickup, but in US cities, pretty much flatlining. So in other words, even though the lockdowns are reversing, household confidence is everything. And with this breakout in America, it appears impacting on consumer confidence. And that could start to play out in the data as we go through the summer months. And that is certainly something that would knock investor sentiment. Secondly, the expectations on fiscal stimulus, I think, could be questioned. We have an extraordinarily divided Congress at the moment in the run-up to the presidential election in November. Some on the Republican side are questioning the need for a large fiscal stimulus because of the rebound in economic activity. So we could end up with something that's a lot smaller than what the markets are expecting, and that could prove quite disappointing. Thirdly, that balance sheet support that I've mentioned a moment ago, that is no longer playing a role. The Fed's balance sheet, for example, has shrunk by about $160 billion over the last 3 weeks. So that support is not as powerful as it was. And then finally, we have the political uncertainty that I've mentioned a moment ago. The election's coming up on the 3rd of November. The polls now are indicating not only that Biden could win the White House, but that the Democrats could win the House and the Senate. And a clean sweep for the Democrats could have implications for certain sectors of the equity markets based on the potential policies of the Democrat Party. So for example, big tech, the driver of this equity market rally, the top 5 shares, for example, make up 21% of the entire S&P 500, and they're all big tech. And if there's an element of policy uncertainty in relation to big tech, that could start to undermine confidence in US equities as well. So quite a lot, I think, over the summer months for the markets to deal with. And in our views, the risks are very high that we're going to get a correction at some point in time. Well, certainly one of the consequences of COVID has been this very strong correlation between risk and the US dollar. So based on what I've just said, if equity markets were to correct lower during the summer months, I would certainly expect the US dollar to strengthen over the short term. However, beyond that, I would expect those correlations to fade and the relative macro story to come back as an important driver of FX. And again, one of the big consequences of COVID has been this very substantial narrowing of the spreads between US Treasury 10-year yield and German Bund 10-year yield. And that's because for quantitative easing from the ECB, it's all about reducing the fragmentation risks. The PEP quantitative easing program is flexible. They can buy more of Italy, and that has an important consequence in relation to reducing the fragmentation risks. German Bund yields have been relatively stable. In the US, Fed rate cuts, quantitative easing, all about getting yields lower. So we've had this substantial narrowing of the spread. And historically, whenever we've had that degree of narrowing, euro dollar has moved higher. And I don't expect this time to be any different. So therefore, by the middle of 2021, we expect to see euro dollar trading at around the 120 level.